when President Trump swiftly directed his team to issue harsh and effective sanctions and tariffs on the Colombian government. Upon hearing, they were denied a U.S. military aircraft full of their own citizens who were deported by this administration. Within hours, the Colombian government agreed to all of President Trump's demands, proving America is once again respected.
Hi everyone, and welcome to the Week Ahead on Nomura Podcasts. It's Friday the 31st of January. My name is Ewan Paracuelas, Chief Southeast Asia Economist at Nomura, based in Singapore. Happy New Year to all of you, and wish you a prosperous Year of the Snake. Despite the holidays, it has not been a quiet week, starting with the news on DeepSeek, which rattled global equity markets, led by the tech sector. The Fed's on-hold decision came and went as expected, but my colleagues in the US did make an important change to their Fed forecasts this year. In the week ahead, there's plenty to look out for, which could again potentially make for a jittery market sentiment as we enter the month of February. Questions like whether global tech stocks face renewed pressures and markets start to really test the US exceptionalism narrative. In that context, we have at the end of next week the US employment report, which could be extra important to watch. Before that, all eyes as well on February 1 if we get tariffs as President Trump may have earlier hinted. Elsewhere, we have the Bank of England decision where a cut is widely expected and some inflation and activity data in Europe which could look soft. In Asia, China will still be out for the first part of the week, but we put India on the spotlight with a likely pivotal central bank decision on tap just a few days after the government's FY26 budget is unveiled. A few things to tackle, so let's dive in.
With our policy stance significantly less restrictive than it had been and the economy remaining strong, we do not need to be in a hurry to adjust our policy stance.
Okay, let's kick off with the US. I'm happy to be joined by Jeremy Schwartz from our US economics team in New York. Hey, Jeremy, welcome back to the podcast.
Hey, Ewan, great to be back.
Okay, as we've just heard from Powell there, the Fed seems to indicate that it will not be in a rush to cut again. Any takeaways from the FOMC, and where does it leave us with our Fed forecasts?
Yeah, so Powell was relatively dovish in his press conference. He noted that he still expects some progress on disinflation. He still thinks that policy is meaningfully restrictive. But at the same time, he did push back on the possibility of a March cut. And that really adds to comments before the blackout period from Governor Waller, again, implying that a March cut was possible but unlikely. So we had thought that March was the base case for when they could cut this year. But now we have revised our expectation. We think they're going to stay on hold through 2025. Recent data have been relatively dovish, and we think that some of that dovishness can continue. We saw some positive signs for disinflation from BLS repeat rent indices, and we expect Q1 residual seasonality for inflation is likely to be more muted than in recent years. We've also flagged in a recent note that cyclical momentum in growth data is likely to be short-lived. So all of that would seem to point towards some easing later in the year. But the thing is, we also expect inflationary tariffs to be announced relatively soon. So the way we had been looking at it, March was a pretty narrow window where they could have cut if they wanted to this year. The fact that there's not a lot of enthusiasm for it means it's now not a good base case, and we have pushed our expectations out to 2026.
Okay, wow, that's interesting. Yeah, and speaking of data, for the week ahead, we have the January employment report on Friday. What are your expectations from that?
Yeah, so we're expecting a pretty benign employment report in January. We think the unemployment rate was unchanged at 4.1%, and we're expecting headline job gains to remain elevated, just shy of 200K. Lead indicators have been consistent with some modest acceleration in the labor market. Service sector surveys have been pretty positive, with the national services PMI employment subcomponent rising to a multi-year high of 54.1. That said, there are some risks in this report. We have the Los Angeles wildfires, which began a week before the NFP survey reference period. Past fires haven't always had a negative impact on employment, but we think the central location and the timing relative to the employment surveys should be a bit of a headwind this month, with risk skewed to the downside. At the same time, there's also going to be a lot of noise in the household survey this month. Every year, the BLS updates their estimates of the population that they base the aggregates from the household survey off of, and they're going to make an unusually large adjustment this year as some estimates for immigration kind of catch up to what we've all known for a little while now and what CBO has been reporting since early last year, that immigration has been much faster than some of the official estimates imply. So that's going to likely lead to a lot of noise in the household survey measure of employment. And we also think it adds some jump risk to the unemployment rate and labor force participation rate. So again, while we're forecasting something that looks like a pretty reasonable middle path and wouldn't be a remarkable set of numbers if it's perfectly realized, this should be a noisier and riskier report than usual in a typical month.
Yep. Okay. Understood. And then finally, there's been a lot of discussion on the 1st of February, which is just around the corner, where we could hear a lot more headlines on tariffs. What is the latest that we hear from Trump on that? And what's our assumption on the implementation?
Yeah, so there's been a lot of announcements from Trump of potential tariffs that could go into effect, some with specific countries, targeted products, specific deadlines. We would really distinguish between things that Trump says versus things that are then followed up by some official steps taken to implement tariffs. And for that, we'd really highlight the day one executive order asking for a series of reports to be put together and delivered by April 1st. On raising tariffs against China, as well as looking into other tariffs against other trade partners. We've also seen news stories that tariffs might be implemented more gradually on a sort of more preset course. But again, we think that a lot of these headlines are more noise than signal. And we've actually remained relatively steady in our expectations that we're likely to get some announcements by Q1 and some implementation in Q2, beginning to hit some of the inflation numbers. Of course, there's a lot of uncertainty around that. There's a lot of latitude for the Trump administration to go in many different directions in terms of who they target, how broad they want to be with tariffs, and how quickly they want to implement tariffs. But again, we think we should continue to distinguish between what Trump says versus what we see some sort of official bureaucratic mobilization to actually achieve.
Yep, excellent. Let's leave it there. Thanks very much, Jeremy.
Yeah, thank you, Evan.
Now, moving to London, I'm joined by George Buckley, our chief economist for Europe and the UK. Hey, George, welcome back to the podcast.
Thank you for having me on.
So first up, we have the Bank of England on Thursday. That's the 6th of February. What do you expect there?
So it seems very likely that they are going to cut interest rates again. They've already done 2 cuts since August last year. This would be their third. They seem to be going at a quarterly pace every monetary policy report meeting. I think also that's quite an important point, that it is a change of forecast this time. In addition to that, every February they do a supply stock take. So they look at what's happening to the supply in the economy and try and work out where demand is relative to that supply. So it's an annual supply stock take. It will influence their thinking. But it seems very likely, with 3 members having voted for a cut at the last meeting, that this is probably the closest you can get to a certainty that they will move. And the market thinks that as well. So markets, consensus, and ourselves all looking for a 25 basis point cut. Interesting.
And do they provide a forward guidance in terms of what the path going forward is?
They do, and I don't think they will change that this time. It's going to talk about the gradual approach to loosening policy, the fact that policy needs to remain restrictive for some time. It is still restrictive at 4.5%, which it would be where it is if they do cut interest rates. And obviously continuing to monitor closely inflation persistence. All those elements of guidance, I think, will stay the same.
Okay, got it. So that's the Bank of England. Any other things to watch out for in terms of the data next week in Europe or in the UK?
There's not a huge amount, but what I would say is look out for the inflation data early in the week for the euro area. Now, it's as we speak, loads of inflation figures are coming out this week. So the euro area headline will be obviously an aggregate of those. So difficult to say exactly where that's going to land. But I think the one thing I would say is watch out for services inflation, and particularly the ECB seasonally adjusted measure of services inflation, because that can tell us what the ongoing momentum in prices is doing. At the moment, it's running at just under 3% annualized, which would be consistent with the inflation target. The other thing to watch out for is industrial production. In particular, Germany's been exceptionally weak, but all countries, all major countries in Europe, the big four, are still below where they were back just before the pandemic started. So things have been very weak, but especially in Germany.
Okay, thanks. And finally, our U.S. team, as mentioned by Jeremy earlier in the podcast, have changed their forecast. They do not expect any Fed cuts this year, as opposed to the previous forecast of one more in March. Does that influence the path for monetary policy easing for you, for both the Bank of England and ECB at all?
I think it does. It certainly presents a risk to our view, because no cuts in the US and cuts in Europe. We have had these divergences before, and typically in this direction as well. You've often seen, or occasionally seen, the Fed having been more hawkish, for example, than the Bank of England or the ECB. I think in this occasion, there are genuine reasons to think that the Fed should be more hawkish. The economy has recovered more quickly. The impact of tariffs is going to be much more sizable on inflation. There's a much greater concern in Europe about the growth implications if tariffs are implemented. So I think lots of reasons why you could justify this difference between pricing for the BOE and ECB on the one hand and the Fed on the other. But still, I think it does represent a risk to our cuts view for the UK, and that's also for the UK and the euro area, and that's also shown in market pricing, because market pricing is for less cuts than we have for the BOE and ECB.
Great, that's really interesting. Let's leave it there. Thanks very much, George.
Thank you, Ewan.
Now, for Asia, India is on the spotlight, and my next guest is Sonal Varma, our chief economist for AEJ in India, to discuss what's in store in the coming week and what to expect. Hey, Sonal, thanks very much for joining the podcast despite being on the road at the moment.
Thanks for having me, Ewan.
Okay, just first question. I guess we have the budget on Saturday. That's the 1st of February. What are the main things you're looking out for, and what are your expectations?
Yeah, so this budget is actually being presented in the backdrop of weak domestic demand. So really the key question is whether the government will go for fiscal discipline or announce measures to support growth. Our view is it's going to be a mix of both. So we are expecting some targeted measures to support growth. For instance, some tweaks to the personal income tax brackets such that the disposable income for middle income households goes up. We're also expecting a step up in the pace of public infrastructure spending after what's been very weak spending over the last 9 months. But we do think the government is going to stick to fiscal consolidation. So this year's budget deficit target is 4.9% of GDP. We think they're going to better it at 4.8. And we think next year, that's the fiscal year 26, they're going to set a target at 4.4% of GDP. So showing continued consolidation. Now, typically, budget also tends to be a platform to announce any medium-term focus and reform plans. So on that, we think there'll be focus on more job creation, increasing investment in agriculture, some incentives to attract manufacturing supply chains to India. And I think the final thing we'll be watching is any more clarity on the medium-term fiscal plan, because India is going to shift from fiscal deficit targeting to debt targeting from FY27 onwards. So lots to watch there.
Yeah, it sounds like it. And of course, shortly after the budget, on the 7th of February, we have the big event, the MPC decision of the RBI. So what do you expect from that as well? And does the budget have some bearing on the outcome, or is it mostly about growth and inflation?
The budget will have some bearing. So if we get a more prudent fiscal stance, then it will mean some more elbow room for monetary policy to support growth. This MPC is also important because it's going to be the first meeting of the new RBI governor, Sanjay Malhotra. We are expecting a 25 basis point repo rate cut to 6.25%, which is going to be the first cut in this cycle. We think the stance will be retained at neutral, and this should be a unanimous decision. On the growth inflation dynamics, I think, despite a weak currency, inflation, in fact, is tracking lower at 4.5% in Q1 and around 4.1% on average in the next 12 months. And this is primarily because of lower food prices. This is in line with the RBI's projections and also close to its midpoint target of 4%. On the other hand, growth has been much weaker than the RBI's projections. So we're expecting them to downgrade their FY26 GDP growth forecast to around 6.5% from 7.1%. I would say our own growth projections are even lower at around 6%. So we think this is going to be the start of a deeper easing cycle. We are expecting 100 basis point in total cuts this year.
Yeah, interesting. And I guess staying on monetary policy, I guess the other reason why India is in a little bit of a spotlight is, I guess in the last week or so, as you put out in your report, you were saying that RBI has brought the cavalry in trying to address the liquidity crunch. Did that announcement surprise you? And importantly, does that increase further your confidence that RBI will indeed start cutting next week?
Yes, it does actually. So the RBI announced OMO bond purchases, long-term variable rate repo operations, and FX swaps. So the three measures together are going to inject durable liquidity. We were expecting the RBI to announce liquidity easing measures because their own FX intervention had drained banking liquidity. And, without injecting liquidity, rate cuts basically are a wasted bullet because policy transmission gets hamstrung. But the timing of the announcement, the choice of instruments, and the quantum of liquidity injection, they were all a positive surprise. We do think, therefore, this is a pretty strong signal that the RBI is prioritizing domestic growth over currency risk. And we agree with this approach because India largely attracts growth-sensitive capital flows. I would say we think actually a regime shift is underway. With the RBI now looking for allowing more FX flexibility. We think there'll be further liquidity easing measures in the coming weeks and months, including more government bond purchases. So on the whole, it does increase our conviction that a repo rate cut is likely next week and that this is going to be the start of a deeper easing cycle in India.
Yep, makes a lot of sense. Yeah, let's leave it at that, Sonal. And thanks again for joining. Safe travels.
Thanks, Yuban.
That's it for now, and thank you again for joining us at Nomura Research on the Week Ahead, edited and produced by John Dalton. If you enjoy the content, please like and subscribe to Nomura's podcast on Apple, Spotify, and SoundCloud, or your usual provider. We'd love to hear your feedback, so please feel free to write a review and share this podcast to anyone you think might be interested. You can also check out NomuraConnects.com for more of our research and updates. Have a great week ahead.
In a complex and unpredictable world, where a sunset in one market means a sunrise in another, one investment bank always looks beyond the horizon to help our clients release the potential of tomorrow, today. Nomura, connecting markets, east and west.
Disclaimer. This content has been prepared by Nomura solely for information purposes. It is not intended to form the basis of any investment decision and is not an offer or solicitation of an offer to buy or sell or enter into any agreement with respect to any security, product, service, including but not limited to investment advisory services or investments. The opinions expressed in the content do not constitute investment advice nor is legal, regulatory, accounting, or tax advice and may change at any time without notice. You should seek independent advice as appropriate for individual circumstances. For further information, disclaimers and disclosures, please visit Nomura Connects at www.nomuraconnects.com.